Hey there. Ready to unravel a topic that touches almost everyone's wallet but often feels like a secret code? Today we're taking a deep dive into the federal income tax formula for individuals. It might sound a bit like homework, I know, but trust me, understanding its structure can lead to some truly illuminating aha moments about your own finances. We've gathered some fantastic sources to guide us, exploring the core of individual income taxes, from what the IRS considers income to those often confusing deductions and credits. Our goal today is really to demystify this formula, clarify the essential building blocks, and show you exactly how they fit together to determine your tax liability or, fingers crossed, that much anticipated refund. Think of this as your personal shortcut to truly understanding a fundamental part of your financial life.
Indeed. And what's often overlooked, I think, is that behind the perceived complexity of our tax system lies a surprisingly logical formula. Once you grasp this framework, it provides a clear roadmap. We'll be navigating the current tax law, including the significant shifts brought by the Tax Cuts and Jobs Act of 2017, and even looking ahead to some crucial upcoming changes. Our aim is to equip you with the knowledge not just of what these components are, but why they strategically matter to you, right down to your filing status and opportunities for smart financial planning.
Okay, let's unpack this tax formula then. Our research highlights that it's the very foundation for applying federal income tax, directly mirroring the structure you actually see on your Form 1040. So what are these core components that make up this journey from, your total income down to your final tax bill?
Well, the tax formula is kind of a journey, like you said. It starts broad and gradually narrows down. It begins with income broadly defined, which means almost everything that comes in your door, whether it's taxable or not, like gross receipts. The critical insight here really is what it doesn't include. Right. Things like borrowed funds or a simple return of capital, because those aren't considered, new wealth.
Okay, so if it's broadly defined, then we have exclusions, right? These are specific types of income that Congress has intentionally chosen to keep out of the tax base.
Exactly. Think of exclusions as legislative kindness, maybe. They're income you receive, but you don't pay tax on it. Common examples we see in our sources include things like accident insurance payouts, child support payments, the value of gifts and inheritances,
Oh.
life insurance proceeds received at death, and welfare payments. These are all part of your economic inflow, sure, but Congress decided not to tax them.
So when we take that income broadly defined and subtract those exclusions, we arrive at gross income. Our sources emphasize that this is a truly all-encompassing concept, defining it as all income from whatever source derived. It's fascinating how broad this is, covering everything from compensation for services to dividends and even, surprisingly, gains from illegal activities or embezzled funds. No escaping income there, it seems.
Not really, no.
Now, once we have gross income, the next step involves a set of, powerful deductions that can significantly reduce that number even before you consider itemizing. We're talking about deductions for adjusted gross income, often called above-the-line deductions. What makes these so important?
These above-the-line deductions are crucial because they directly reduce your gross income, shaping a number known as your adjusted gross income, or AGI. This happens before you even get to the choice of standard versus itemized deductions.
Wow.
Examples include things like business expenses for the self-employed, a portion of self-employment tax, certain alimony payments for divorces finalized before 2019,
Right.
contributions to traditional IRAs, and student loan interest. The key insight is that these are universally beneficial. You get to claim them whether you itemize or not.
That brings us to AGI itself, adjusted gross income. This isn't just another number, is it? It feels like a real financial gatekeeper.
Absolutely. AGI is a critical benchmark. The key insight here is that strategically managing your AGI can unlock or restrict access to a whole cascade of other tax benefits down the line. Many other deductions and credits are limited by or phased out at certain AGI levels. So yeah, reducing your AGI is a foundational lever in effective tax planning. From AGI, we then move to deductions from adjusted gross income. And this is where you face a pivotal choice for many taxpayers, whether to take the standard deduction or itemized deductions.
Right, this is where it gets interesting for a lot of people. What exactly falls into that itemized category?
Well, itemized deductions are a collection of specific personal expenses that Congress allows you to deduct. Our sources highlight common ones like medical expenses, but only the amount that exceeds 7.5% of your AGI. Charitable contributions are another big one, deductible up to 50% or even 60% of your AGI, depending on the type of contribution. A critical point for now, though, is that many other non-business expenses, like miscellaneous itemized deductions, are suspended from 2018 through 2025. Yeah, suspended. This means you generally can't claim them for these years. Things like unreimbursed employee expenses, for example.
Ah, okay. So if my itemized deductions don't add up to much, especially with those suspensions, I can simply take the standard deduction. That sounds like a much simpler path.
Precisely. The standard deduction is a fixed amount, adjusted annually for inflation, that varies based on your filing status, age, and whether you're blind. It provides a minimum amount of income that's sheltered from tax. For many, especially after the 2017 tax law changes dramatically increased it, it's often the more advantageous choice.
And speaking of those changes, I remember a lot of talk about exemptions. What happened to those? They used to be a big deal.
They were. Historically, personal and dependency exemptions were cornerstone amounts you could deduct for yourself, your spouse, and each dependent. Big numbers sometimes. However, our sources clarify that these exemption deductions are suspended from 2018 through 2025. Gone for now.
So just gone.
The deduction part, yes. Congress compensated for this by significantly increasing the standard deduction and expanding child tax credits. But here's a key insight, and it's important. Even though the deduction is suspended, the exemption amount itself, which is $5,200 in 2025, still serves a crucial role.
Oh, so
Well, for instance, it's the benchmark for the gross income test for a qualifying relative, a detail that can make or break whether you can claim someone as a dependent for certain credits. So the number still matters, just not as a direct deduction. And this brings us to a really important point about the upcoming year. The 2017 Tax Cuts and Jobs Act, the TCJA, it reshaped so many of these components: the standard deduction, the suspension of exemptions, the structure of the credits.
right.
Many of these individual provisions are set to expire at the end of 2025. They just sunset.
So things could change back.
Potentially, yes, unless Congress acts. This isn't just a political footnote. It creates a unique and immediate window for proactive tax planning. The insight is that understanding these impending changes now allows you to strategize, perhaps, by accelerating certain deductions into 2025, or maybe deferring income until 2026, depending on your individual situation and what you anticipate the future tax landscape might look like.
Okay, that's a really good heads up. So once we factor in all these deductions, whichever path we take, we arrive at our taxable income. Then the tax rates are applied, and finally we account for things like taxes already withheld and any tax credits to get to our final tax due or refund. That's the full journey. Phew! Let's delve a bit deeper into that standard deduction, particularly those extra amounts you mentioned. Who qualifies for the additional standard deduction?
Right. The standard deduction offers extra amounts, these little boosts, for those 65 or older or blind. For example, in 2025, a single taxpayer who is, say, both 66 and blind would get a significantly higher standard deduction than a younger, sighted single person, two additions in that case. These add-ons can significantly increase the tax-free portion of your income, especially for single filers with multiple qualifications. However, a key point is you cannot claim these additional deductions for your dependents, only for yourself or your spouse if filing jointly.
That's a good clarification. Our research also highlights specific situations where an individual might not be eligible for the standard deduction at all, like married individuals filing separately where one spouse itemizes, or non-resident aliens. That seems like a really important detail, especially for married couples deciding how to file.
It absolutely is. The underlying principle here is consistency within a household. If one spouse chooses to itemize deductions...
Maybe they have huge medical bills or mortgage interest.
Exactly. If one spouse itemizes, the other must also itemize, even if their itemized deductions are far less than the standard deduction they could have taken individually. So, for example, if one spouse itemizes deductions totaling, say, $17,000, but their partner only has maybe $1,000 in itemized deductions, that partner still has to itemize for just $1,000.
Ouch. They miss out on the much larger standard deduction they might have otherwise gotten.
Precisely. This interconnectedness truly highlights how tax decisions are often a shared endeavor, or at least have shared consequences, in a marriage.
And what about dependents? You mentioned they can't get the additional standard deduction. Are there other special limitations for them when claiming their own standard deduction on their return?
Yes, there are specific rules here. They're basically designed to prevent tax planning, where unearned income, like investment income from stocks or bonds, is simply shifted to a child to be sheltered by a full standard deduction.
Ah, okay. So how does it work?
For a dependent, their standard deduction is generally limited. It's the greater of a minimum amount, like $1,350 in 2025, or their earned income, plus a small additional amount, maybe $450. But critically, it can never exceed the basic standard deduction amount for their filing status, like single.
So if a dependent has, say, $1,000 of earned income from a summer job.
Then their standard deduction would be limited to a specific amount calculated based on that $1,000 plus $450, so $450 in this example. That's often less than the full standard deduction an independent adult would receive.
Right. And if they only had unearned income.
Then their standard deduction would be limited to that minimum amount, the $350 for 2025. The crucial point is that this rule means a dependent, especially one with only unearned income, might pay tax on a larger portion of it than an adult would.
That makes a lot of sense, preventing income shifting.
Yeah.
Okay, speaking of dependents, let's talk about the rules for determining who actually qualifies as one. Our sources break it down into a qualifying child and a qualifying relative. What are the core distinctions? They sound similar.
They do, but the distinctions are critical because they dictate who you can claim and for what benefits, like the child tax credit. For a qualifying child, we're looking at specific criteria. First, a relationship test. It's typically your child, stepchild, foster child, sibling, half-sibling, step-sibling, or descendant of any of them, like a grandchild.
Okay, pretty close family ties.
Generally, yes. Second, a residence test. They must live with you for more than half the year. Temporary absences, like for school, usually don't count against this. Third, an age test. Generally under 19 at year-end or under 24 if they're a full-time student for at least part of 5 calendar months during the year. Or they can be any age if permanently and totally disabled.
And they can't be older than you.
Correct. An often overlooked point, the child cannot be older than the taxpayer claiming them unless disabled. And finally, a support test. They must not have provided more than half of their own support for the year. Importantly, scholarships received by a student generally don't count as support provided by the child for this test.
Got it. Relationship, residence, age, support. What if more than one person could claim the same child? Say, divorced parents or a child living with grandparents. I've heard about tiebreaker rules.
Correct. The tax law anticipates these situations, thankfully. It provides specific rules for priority. Generally, parents get priority over other relatives. If both parents could claim the child, the parent the child lived with for more time during the year usually gets the claim. There are further rules if time is equal or if non-parents are involved. It helps resolve common family dilemmas. Now, for a qualifying relative, the rules are different and often broader in some ways, narrower in others.
Okay, so.
The relationship test is much broader here. It includes those qualifying child relationships, but also lineal ascendants like parents or grandparents, collateral relatives like aunts and uncles, and even unrelated individuals like a friend or partner if they lived in your household as a member of your family for the entire year.
Interesting. What else?
Then there's a crucial gross income test. Their gross income for the year must be less than the exemption amount, which, as we said, is $5,200 in 2025. This is a hard limit and often trips people up.
So if your parent lives with you, but they have pension income over that amount, you might not be able to claim them as a qualifying relative.
Exactly, even if you provide all their support. And finally, the support test here is different too. You must provide more than half of their total support for the year.
More than half. Okay.
And unlike the qualifying child, there's no general age restriction here, but that gross income limit is a very common barrier.
What about divorced or separated parents specifically? Our sources say the custodial parent typically gets the claim unless they waive it. How does that work with these tests?
Right, that's a significant exception, mainly impacting the qualifying child rules for credits. The custodial parent, the one the child lived with longer, generally has the primary claim for dependency purposes, including the valuable child tax credit. But they can choose to release that claim to the non-custodial parent by providing a written waiver, specifically IRS Form 833D2. The non-custodial parent attaches this form to their return.
So it's a formal process.
Yes, it provides necessary clarity in what can otherwise be complex and sometimes contentious family situations.
All dependents, whether qualifying child or relative, also have to pass a joint return test and a citizenship or residency test, right?
Yes, essentially 2 final hurdles. A dependent generally cannot file a joint return with their spouse for the year. Unless that joint return is filed solely to claim a refund of withheld income tax or estimated tax paid, and neither spouse would have a tax liability if they filed separately. It's a narrow exception. And for the current tax environment, specifically for claiming tax credits like the child tax credit or the other dependent credit, the dependent must typically be a U.S. citizen, U.S. national, or U.S. resident alien. Residents of Canada or Mexico could qualify someone as a dependent in the past and might still for some purposes, but generally not for the main credits now.
Okay, all these rules lead us directly to the child tax credit and the related dependent tax credit. How did the suspension of those personal exemptions back in 2018 really impact these credits?
This was a crucial policy shift. With the exemption deduction gone, Congress significantly increased and expanded these tax credits as partial compensation. For 2025, under current law, you could potentially see a $2,000 credit for each qualifying child under age 17 at the end of the year.
Under 17, that's key.
Yes, under 17 for the $2,000 credit. And there's also a $500 credit for other dependents who don't meet the qualifying child definition or are age 17 or older, like older children or qualifying relatives. The key here, and why this matters so much, is that these credits are much more impactful than deductions. They directly reduce your tax bill dollar for dollar.
Deductions just lower your taxable income.
Exactly. And a significant portion of the child tax credit, up to $1,700 per child in 2025, can even be refundable. This means you could get money back as a refund even if you owe no income tax to begin with. That's a big deal for lower and middle income families.
That is significant. Now, let's tackle something many parents with investments for their kids might encounter: the kiddie tax. Our sources indicate that a child's unearned income can sometimes be taxed at their parents' higher rate. How does that work?
The kiddie tax. Yes, this is a critical rule designed specifically to prevent high-income parents from shifting investment income like interest, dividends, capital gains to their children just to take advantage of the child's typically lower tax bracket.
So it targets unearned income.
Precisely. The basic principle is that if a child has unearned income above a certain threshold, that portion is taxed at the parent's marginal tax rate, not the child's rate. Generally, this applies if the child is under age 19 at the end of the year or a full-time student under age 24, provided their earned income doesn't exceed half their support.
Okay, and what's the threshold?
In 2025, for example, the first $13,350 of unearned income is typically offset by the child's standard deduction. The next $13,350 is taxed at the child's rate, often 10%. And any unearned income above $2,700 is generally taxed at the parent's higher marginal rate. The calculation involves figuring out the child's net unearned income and can be a bit nuanced, sometimes requiring a separate calculation on Form 8615 filed with the child's return.
So parents really need to be aware of this rule if their kids have significant investment accounts, because it can mean a much higher tax bill on that income than they might expect.
Absolutely. It's a key planning point for families with investments for children.
Okay, moving on to filing status. This seems absolutely fundamental. It directly impacts your tax rates, your standard deduction amount, and even your eligibility for certain deductions and credits, doesn't it?
It absolutely is. It's one of the very first things you determine. There are 5 main statuses: single, married filing jointly, married filing separately, surviving spouse, which is sometimes called qualifying widow or widower, and head of household. Your marital status at the very end of the year, December 31st, usually determines your options for that entire year.
Right.
The crucial insight is that choosing the optimal filing status, when you have a choice, can dramatically affect your overall tax liability. Generally speaking, married filing jointly offers the lowest tax rates and highest standard deduction.
And married filing separately.
Often results in the highest tax rates and lowest standard deduction. Plus, it can restrict eligibility for certain credits. It's usually the least favorable, but sometimes necessary.
Our sources often mention a marriage penalty. Can you elaborate on that? Is it still a thing? It sounds like filing jointly is always better.
Not always, though it often is. The marriage penalty, while partially addressed by the PCJA legislation, can still arise, particularly when 2 spouses have relatively similar high incomes. They might find that their combined income pushes them into a higher tax bracket when filing jointly than the sum of the taxes they would have paid if they could have filed as single individuals.
I see.
Congress did try to mitigate this by making the standard deduction for married couples exactly double the single amount and by widening some of the married filing jointly tax brackets compared to single brackets. But for couples with very substantial incomes, particularly those who itemize deductions rather than taking the standard, it can still be a factor. The strategic implication is that these couples, especially high earners, might need to actually run the numbers both ways jointly and separately to understand the true impact, though filing jointly is still usually better overall.
And what about the head of household status? That seems like a potentially beneficial one for single parents or those supporting other relatives.
Head of household status is definitely beneficial. It offers lower tax rates and a higher standard deduction compared to filing as single. It's generally for taxpayers who are considered unmarried for tax purposes or meet abandoned spouse rules, and who maintain a household, meaning they pay more than half the cost of keeping up the home for a qualifying person.
A qualifying person, like a qualifying child.
Often, yes. A qualifying child dependent usually needs to live with the taxpayer for more than half the year. But interestingly, it can also be for a qualifying relative dependent. And there's a special helpful exception for maintaining a home for a dependent parent. The parent doesn't necessarily have to live in the taxpayer's home as long as the taxpayer pays more than half the cost of maintaining the parent's separate home.
That's useful to know.
It is. But it's a status that requires careful determination of both the unmarried status and the maintaining a household for a qualifying person rules. Tax preparers even have a specific due diligence requirement checklist they have to complete to ensure eligibility before filing a return with the status.
Our sources also bring up the abandoned spouse rules. That sounds like an interesting nuance in these family situations. What's that about?
It is, and it provides a critical safety net, really. These rules allow a married taxpayer who might otherwise be stuck filing as married filing separately to instead file as head of household, which is generally much more favorable.
But what are the conditions?
There are specific conditions that must all be met. You must file a separate return from your spouse. You must have paid more than half the cost of keeping up your home for the tax year. Your spouse must not have lived in your home during the last 6 months of the tax year. Your home must have been the main home of your child, stepchild, or foster child for more than half the year, and you must be able to claim that child as a dependent, or could have, except the non-custodial parent claimed them under the waiver rules.
So it helps someone whose spouse has essentially left the home.
Exactly. It provides a more favorable filing status in challenging family situations, helping taxpayers avoid some of the harsher consequences often associated with married filing separately status, like lower deductions and credit limitations.
So once we finally know our filing status and have calculated our taxable income using all those deductions, how is that actual tax liability determined? It's not just one flat rate, right?
Correct. Our system in the U.S. is progressive, meaning higher levels of taxable income are generally taxed at higher rates. Most taxpayers, those with taxable income under $100,000, will simply use the IRS tax table. You find your income range, look at your filing status column, and the table tells you your tax. It's designed for simplicity.
And if your income is higher?
If your taxable income is $100,000 or more, you'll use the tax rate schedules instead. These schedules explicitly show the different tax brackets and the statutory rates that apply to each chunk of income. For 2025, under current law, these rates range from 10% on the lowest income chunk up to 37% on the highest.
Okay. And you mentioned marginal versus average rates earlier.
Yes, and here's a key distinction that's really important for planning. Your marginal tax rate, that's the rate applied to your next dollar of taxable income. If you're considering earning more or taking another deduction, this is the rate that matters most. Your average tax rate, on the other hand, is simply your total tax liability divided by your total taxable income. It gives you an overall picture, but the marginal rate is the one you really need to understand for making financial decisions about income or deductions.
Got it. Marginal rate for decisions.
Yeah.
And then finally, after calculating the initial tax, we have tax credits, which directly reduce the tax liability dollar for dollar. You said these are incredibly powerful.
Precisely. This is a critical distinction that often gets overlooked or confused with deductions. Tax credits directly reduce the amount of tax you owe. A $1,000 credit saves you $1,000 in tax, period.
Whereas a $1,000 deduction,
Only saves you $1,000 times your marginal tax rate. So maybe $120, $370, depending on your bracket. Credits are much more valuable dollar for dollar. These credits, things like the child tax credit, education credits, energy credits, along with taxes already withheld by your employer or any estimated tax payments you've made throughout the year. These are what ultimately determine whether you receive a tax refund because you overpaid or whether you owe an additional amount when you file. They are effectively a direct discount on your tax bill.
okay, that clarifies the whole calculation process.
Yeah.
Beyond the numbers, our sources also cover the practicalities of tax return filing procedures. What forms do most people actually start with? Is it always the 1040?
Yes, everyone starts with the main Form 1040. It's the foundation. However, many, probably most, taxpayers will also need supplemental schedules attached to it. For instance, Schedule 1 is where you report certain additional income sources, like business income, alimony received for older agreements, or unemployment compensation. It's also where you claim those important above-the-line deductions we talked about, like student loan interest or IRA deductions.
Okay, what about other schedules?
Schedule 2 is for reporting other taxes, things like the alternative minimum tax, AMT if it applies, or self-employment tax. Schedule 3 is where you'll find many of the other non-refundable or refundable credits beyond the basic child tax credit, like education credits or foreign tax credits. There's also Form 1040 SR, which the IRS introduced a few years ago. It's specifically for taxpayers age 65 or over. Functionally, it's very similar to the standard Form 1040 using the same schedules, but it features larger print and some layout changes intended to make it easier to read.
That's helpful. E-filing seems to be the strongly preferred method these days, right? Our sources highlight a couple of major advantages.
Indeed, the IRS pushes e-filing hard, and for good reason. First, it significantly reduces reporting errors compared to paper filing. The software catches many common mistakes. That saves you, and the IRS, potential headaches down the road.
And the second?
Speed. It dramatically speeds up refund processing. If you're due a refund and e-file with direct deposit, you can often get your money in a matter of weeks versus much longer for paper returns. The IRS website is an excellent resource for finding information on e-filing options and locating authorized software providers or free file options if you qualify.
And the filing deadline, we all know, is generally April 15th, unless it falls on a weekend or holiday.
Right.
But there's a 6-month extension option, right, using Form 4868. But crucially, that extension doesn't actually extend the payment deadline, does it?
That's a critical point and probably one of the most common misconceptions about extensions. An extension to file requested using Form 4868 grants you more time, typically until October 15th, to submit your completed tax return. It does not, however, grant you more time to pay any tax you estimate you owe. Any payments due should still be made by the original April 15th deadline to avoid potential penalties and interest charges.
So you still need to estimate and pay by April 15th, even if you get an extension to file the paperwork later.
Exactly. Payments can be made in various ways: mailing a check with Form 4868, using IRS Direct Pay Online, the Electronic Federal Tax Payment System, EFTPS, if you're enrolled, or even by credit or debit card through third-party processors, though be aware they usually charge a fee for that service.
Okay. What if you file your return, maybe you rushed near the deadline, and then later you discover an error, a forgotten deduction, maybe some income you missed? We're talking about amended tax returns.
Right. If you discover an error after you've already filed, the way to correct it is by filing Form 1040X, Amended U.S. Individual Income Tax Return. You explain the changes and recalculate your tax. There are deadlines for filing an amendment to claim a refund. Generally, it's within 3 years from the date you filed your original return or within 2 years from the date you paid the tax, whichever is later.
3 years or 2 years, okay.
But here's a helpful insight, a sort of pro tip. If you catch an error before the original due date, including extensions, of your return has passed, you don't necessarily need to file Form 1040X. You can simply file a corrected or superseding return using a regular Form 1040. As long as it's filed by the due date, this later corrected return completely replaces the original one you filed earlier. It can be simpler than an amendment.
Ah, that's good to know.
Yeah.
File a new 1040 before the deadline beats amending. Okay, finally, let's talk tax planning. How can truly understanding this whole formula we've walked through actually empower you to make smarter choices?
This is really where the knowledge becomes powerful, moving beyond just compliance. One key area, especially with the higher standard deductions now, is maximizing its use, or knowing when to itemize. The insight here is to always compare your potential total itemized deductions to your available standard deduction amount for your filing status. This isn't just a simple calculation at tax time. It can be a strategic decision you plan for during the year.
How so?
Well, for instance, if you find yourself typically close to the standard deduction threshold each year, but maybe just under it, you might consider bunching certain controllable itemized deductions.
Bunching?
Yeah, like maybe making 2 years' worth of your planned charitable contributions in 1 year, or scheduling elective medical procedures to fall in the same year if possible. By concentrating those deductions into 1 year, you might push yourself significantly over the standard deduction amount for that year, getting a bigger tax benefit.
And then the next year?
Then the following year, when you have fewer itemized deductions, you'd simply take the standard deduction. It requires planning, but it can optimize your deductions over a 2-year period compared to just missing out on itemizing each year. Factors like age, blindness, which increase the standard deduction, home ownership, mortgage interest, property taxes are itemized, and marital status all playing into this optimization.
That's a classic strategy. So, yeah, if you're close to itemizing, strategically accelerating deductible payments, like those charitable gifts before year end, could make real sense.
Exactly. Another critical planning area revolves around dependents. We talked about the tests. Understanding the gross income test for a qualifying relative, for example, can help you plan financial contributions to their support to ensure you meet the over half support test and they stay under the income limit, allowing you to maintain that dependency claim and the related $500 credit. And for a married person you might otherwise claim as a dependent, maybe an adult child who got married, remember that joint return rule. If they file a joint return, that dependency could be disallowed.
But there was that exception.
Right, the helpful exception. If they file jointly solely to recover withheld taxes and they actually owe no tax liability individually or jointly, the dependency can potentially still stand. Knowing that nuance can be important.
And back to the kiddie tax. Any specific planning tips there to perhaps minimize its bite on investment income for kids?
Absolutely. Since the kiddie tax primarily targets unearned income, one strategy is to shift investments for younger children towards assets that defer taxable income until they are older, potentially past the kiddie tax age limits.
Like what kind of assets?
Things like U.S. government savings bonds, Series E or I bonds, where the interest income isn't taxed until the bonds are redeemed. Or perhaps investing in growth-oriented stocks or mutual funds that don't pay out significant current dividends. The value grows, but the tax hit comes later, ideally when the child is older and taxed at their own lower rate. Another smart strategy, if it fits your situation, is to legitimately employ your child in your own business, if you have one.
Employ your child.
Yes, pay them a reasonable wage for actual work they perform. This converts what might have otherwise been unearned income, if you just gave them money, into earned income for the child. Earned income is taxed at their typically lower rate and isn't subject to the kiddie tax in the same way. Plus, the wages paid can be a deductible business expense for you. It needs to be legitimate work and reasonable pay, of course.
That's clever. So it really sounds like understanding these rules isn't just about avoiding penalties or filling out forms correctly, but about making informed choices throughout the year that can genuinely improve your financial standing.
Precisely. Knowing your marginal tax rate, for instance, provides that crucial insight into how additional income or potential deductions will truly affect your bottom line tax bill. That helps you structure financial transactions like investment sales or retirement contributions much more advantageously. And while it's less direct for specific planning decisions, understanding your effective tax rate, your total tax divided by your taxable income, can also be a good indicator over time of how efficiently you're managing your overall tax situation compared to others or your own past years. Puts the numbers in context.
Wow, what a deep dive indeed. We journey through the intricate components of the federal income tax formula for individuals, from those broad income definitions down through the crucial deductions, the sometimes confusing nuances of dependence, and those powerful tax credits. We've explored the practicalities of filing and, perhaps most importantly, uncovered some smart, actionable planning strategies that people can actually use.
What's truly impactful here, I think, is recognizing that individual income tax isn't just a static set of rules frozen in time. It's a dynamic system, significantly shaped by major legislation like the TCJA. And critically, with many of those key TCJA provisions for individuals actually set to change again very soon at the end of 2025. Understanding these foundational elements give you a powerful tool to make better, more informed financial decisions, whether you're just navigating your annual return or making longer-term plans for your financial future.
So, what does this all mean for you listening right now? It means that even seemingly small decisions about your finances, from how you structure your investments to how you contribute to a family member's support to when you make a charitable donation, can have real ripple effects on your tax liability. And knowing the why behind these rules, not just the what, puts you squarely in the driver's seat of your financial journey. And maybe for a final thought to mull over, as we stand here looking towards the end of 2025, with so many of the TCJA's individual tax provisions potentially expiring, how might a future where tax rules, rates, and deductions possibly revert back to something like their pre-2017 state influence your long-term investment decisions or income-generating strategies starting now? It's a powerful question to consider for your financial planning today. Until next time, keep digging deeper and stay well informed.